and welcome to the new series of Drishti IAS. Today we are going to deal and analyze the issue of the falling of the rupee when we compare it to the dollar. Now, this topic is very important from the perspective of economics. Anybody who has economics as an optional, this will help you. And also from the perspective of GS Mains paper 3 and 2, it can span across 2 as well. And from the perspective of prelims, the facts are important. Let us begin with the various topics that we are going to acknowledge under this particular segment. From the news to currency depreciation, what is it? What is the value of rupee and how is it determined? The reasons for the fall in value, the impacts, this could be a double-edged sword, currency depreciation, way forward, and in the last we have our question. So the free fall of the rupee in such a sense that it is going so down that it is being seen that without any control it is falling. So this particular issue is something that the Central Bank of India is trying to address. Also, at current rate, at the rate at which we are seeing the fall of the rupee, some analysts are saying that this is going to fall further, because since decades we are seeing that rupee is getting weaker against the strengthening of the dollar. Moving on, if we talk about currency depreciation, what is it? It is the fall in the value of a currency in any economy. Whenever the value of the currency falls, that means I could have been buying more stuff with rupees 100. Now I am buying less stuff with rupees 100. That is the currency value of currency is coming down. And this is in the floating exchange rate system. What is this basically? The floating exchange rate system in macroeconomic and policy making, floating exchange rate system, the currency is determined by the fluctuations in the foreign exchange market. So we follow floating exchange rate system. Now the rupee is weakening past the 79 rupees to a dollar mark. For $1, it is equivalent to 79 rupees. And on Wednesday, the selling was as low as 79.05. As I told you, analysts are saying that it is going to free fall. I can use that term, free fall, in the further coming weeks as well. So much so that the IMF has said that the rupee will weaken past the 94 rupee mark to a dollar, that is by fiscal year 29. This is a data that could be asked in an examination. Okay, so one thing that I would like to suggest, I will try to make this free of data as of now. Why? Because when you are going to give your prelims next year, so make sure that you know, even for the mains, make sure that you understand the data closer to the exam that you have. Data might fluctuate then. So weak global economy is one of the reasons. Since the COVID-19 pandemic hit, emerging markets such as India are seeing that the assets are getting devalued, and that is one of the reasons. The war which has caused India to buy more oil, which meant that we are sending more rupees into the market. More rupees into the market, that means less importance and value of the rupees. So as we are buying more and more oil, what we are doing, we are radiating rupees into the market. Whenever we are radiating rupees into the market, what has happened? That whenever we are supplying more, but the demand is not more, or the demand is not matching the supply, what happens? That the value of the currency falls down. Outflow of funds as investors move a fund to high yielding investment instruments. For example, because the US has raised its interest rates, since then we are seeing that people who have invested in India, because of the weakening of the rupee, they are taking out their investment and investing in such countries which are giving them higher return. Rising import costs and a growing current account deficit, because we are importing more and exporting less. Also, the rising import costs because India is an oil dependent country. 80% of the oil is that we order from abroad. So because of that, the import cost is rising and inflation is also rising. And then whenever domestic inflation rises, it has an impact on the value of the currency, because value is coming down. Okay, US Federal Reserve has been raising the benchmark interest rate, causing many people to move to the US for investment. High inflation in India suggests that RBI has been creating rupees at a faster rate than the US Federal Reserve. More supply, less demand, value comes down. Moving on, there have also been steps that are taken by the RBI to support the rupee. This is one of the reasons that is being seen that value of rupee is coming down. What does the RBI say? RBI is saying that our assets in abroad, if they are benchmarked at euros, and yen, because euro and yen are also weakening. Because if these currencies are weakening against the dollar, what is happening? It is simple that the foreign investment in assets, if that is coming down, the impact will be on the value of rupee as well, because now we are comparing the rupee not to dollar but yen and euros, right? So RBI officials have noted that the drop in forex reserve is due to the fall in the dollar value of assets, because forex reserves have also come down. You can look at the data from any good newspaper such as the Hindu, but I have not taken it here because it is not necessary as of yet. Whenever you will go to give the mains, search then what is the forex value. Okay, moving on. What is the value? How is the value of the rupee determined? Determined by in any economy, it is determined by the demand as well as supply for the currency. If the demand is lot but supply is less, the value will increase. If the demand is more, that I have covered, if the supply is more and demand is less, value is impacted. In wider economy, central banks determine the supply of currency like RBI, while the demand for currencies depends on the amount of goods and services produced in the economy. Okay, so these are the factors from which value for currencies are noted. In the foreign exchange market, the supply of rupees is determined by the demand for imports in various foreign assets. So in forex market, what happens? If the demand for import will be high, okay, we are importing and we are making our import costs higher, that will lead to inflation in the country, value will decrease of the money, and that in the forex market, how it determines the value of any currency. Demand for rupees in the forex market, on the other hand, depends on the foreign demand of Indian exports. If people want to export from India, they will have to, of course, ensure that they have enough money, rupees, not money, rupees in order to pay for it. That means the demand for rupees will be higher, and supply, if it is pegged at such an instance that it gives us positivity towards the rupee, then the impact will be positive on the rupee. Okay, so other domestic inflation, see, whenever a country such as India will get itself in inflation, what happens? It will have an ill impact on the value. Inflation means rise in the general prices of commodities over a period of time, and whenever such instances will be there, a bit of inflation is necessary, but prolonged inflation is not very healthy. Import, what are the impacts? Import bills, of course, higher, because now if we could buy more dollars for n number of rupees, now we cannot buy that amount of dollars for n number of rupees, and that makes the import bill higher. Okay, it pushes inflation even higher. And then FPI outflows, foreign portfolio investment, people who are investing in our country, they will move out to another country because the returns are not very lucrative. As a strong dollar is good for export oriented companies, the companies that are exporting, of course, if they will export more, they will earn more dollar, and that is positive. So we have to increase our exports. It is bad for import oriented industry like oil, gas and chemicals, on which India is heavily dependent. And we see that because of the Ukraine or Russia war, we are impacted in an ill way. It is also bad for companies which pay foreign company royalties for franchises in India. Oil and other imported components will get costlier, which will further lead to even higher inflation, and it will have an ill impact on auto, real estate, infrastructure sector. It would be worst hit. ITs and banks, they will be impacted positively. This is according to an analyst. Now, what is the way forward? First way forward is we have to ensure that hedging is done as investors. That means we have to put our assets or money in such a manner, invest in such a manner that we are providing high premium for it to safeguard our returns, but that reduces the potential of profit because we are giving higher premium, and because of that we are not taking any risk, and that is why potential for profit will be lesser. And rupee is likely to continue to depreciate against the dollar given the significant differences in long run inflation. Also, people who are wanting to study abroad, for them it is going to burn a hole in your pocket. Other countries and emerging markets in particular will be forced to raise their own interest rate, because as India is one thing, US has increased its interest rate. Because of that, India will also have to do so, and because of that, many other countries and emerging markets will do so. This is one of the you can say the way ahead. The RBI too has been trying to rein in domestic consumer prices, which hit a 95-month high of 7.8% in April by raising rates and tightening liquidity. So liquidity has to be reined in. Why? Because it will be too much money chasing too few goods. Whenever we have a lot of money but we do not have a supply of goods to match that, then inflation comes into the picture, because many people are demanding for those commodities and the supply is not a lot. So in order to do that, it is happening not only in India, but US is also seeing a 41-year high of inflation. So inflation is something that is straddling, every country is straddling right now, on top of which. So this is a prelims question. Answer this correctly. I will take your names. Whoever has answered it correctly. Which one of the following is not the most likely measure the government or RBI takes to stop the slide of Indian rupee? This is a question from 2019 prelims. Curbing imports of non-essential goods and promoting exports. Encouraging Indian borrowers to issue rupee denominated masala bonds. Easing conditions relating to external commercial borrowings following an expansionary monetary policy. So answer it correctly. That's it for today. Tomorrow we shall meet again with another segment. Until then, stay updated, and thank you so much for watching.